First, welcome to the video. Today we will explain why manual budgeting with spreadsheets and basic expense apps collapses as your financial life grows, and we will show you how to shift to automated systems that save hours and deliver insights. We will also compare subscription-based syncing platforms with robust free accounting tools, outline a step-by-step transition plan, and offer practical tips to test your categories before paying for anything. Next, a quick disclaimer. This video is educational only and not financial, legal, or tax advice. Please conduct your own research and consult a qualified professional before taking action. Your situation is unique and results will vary. Moving on, here is the agenda. We will cover the problem with manual budgeting, explain why automation wins, review 2 proven system paths, provide a step-by-step transition plan, show how to test your categories before paying for anything, include quick quizzes to check understanding, and end with key takeaways and next steps. Now, let us define the problem. Manual budgeting seems fine early on, but as your accounts multiply and transactions increase, exporting statements, merging spreadsheets, and hand categorizing becomes a time sink. Formulas break, reports lag, and insights arrive too late to help. The result is burnout and abandoned tracking. Then, let us analyze why manual spreadsheet budgeting fails. First, it does not scale. As accounts grow, the work increases exponentially. Second, human error creeps in through broken formulas, missed transactions, and duplicates. Third, insights lag because reports are built monthly instead of real time. Fourth, the opportunity cost is high because hours are spent compiling data rather than making decisions. Finally, motivation suffers because the process is tedious, which undermines consistency. The flowchart illustrates how multiple accounts lead to manual exports, merges, categorization, and ultimately errors and fatigue that result in wrong reports or abandoned tracking. After that, here is why automation wins. Aggregation brings checking, savings, credit cards, and investments into one place. Secure connections sync transactions daily. Rules-based categorization ensures speed and consistency. Dashboards deliver instant views of spending, cash flow, and net worth. As a result, you spend minutes per week reviewing and approving instead of hours compiling. Additionally, there are 2 main paths. On the left, subscription-based syncing platforms cost around $50 per year and provide automatic imports, rules, built-in budgets, and instant reporting, which minimizes manual work and suits busy professionals. On the right, free accounting software tailored for envelope budgeting delivers deep historical control and custom reporting with high flexibility, but it requires more discipline and setup time, making it ideal for power users who enjoy fine-grained control. Furthermore, here is a 7-step transition plan. First, map your accounts by listing every checking, savings, credit, loan, and investment account. Second, define categories starting broad. Third, choose your path, either a syncing platform or free accounting. Fourth, connect accounts with secure feeds or import an initial file. Fifth, build rules so that pay names trigger categories and transfers auto-match. Sixth, adopt a weekly 10 to 15-minute review ritual. Seventh, conduct a monthly reflection to adjust budgets, envelopes, and rules. The sequence diagram shows data flowing from bank APIs to the sync platform, rules being applied, your weekly approvals, and dashboards delivering real-time analytics that you refine over time. Meanwhile, this table shows what to track across accounts. For checking, maintain date, payee, category, and amount for items like rent and groceries. For credit cards, record date, merchant, category, and amount for spending such as dining or subscriptions. For investments, track date, transaction type, amount, and symbol for contributions, dividends, and trades. For loans, track date, payment, and principal versus interest components for mortgages or student loans. Next, here is a Markdown-based guide to test your categories before paying. First, create separate tabs per account named checking, credit, investments, and loans. Second, define a master category list with broad buckets such as housing, food, transport, insurance, subscriptions, utilities, discretionary, giving, taxes, savings, and investing. Third, use a weekly checklist to import or sync, auto-categorize, review exceptions, reconcile balances, and capture notes for anomalies. Finally, only when the category list feels right for 30 days, consider choosing a paid tool. Then, this mind map organizes the decision space. The central node is Budget System Choices. One branch covers syncing platforms with auto-import, rules and tags, instant reports, low manual work, and suitability for busy professionals. Another branch covers free accounting with deep historical control, custom reports, the discipline required, do-it-yourself setup, and flexibility for power users. A third branch summarizes common must-haves, such as bank sync or import, clear categories, weekly reviews, monthly reports, and backups with security. Afterward, this pie chart contrasts weekly time allocation before and after automation. Before automation, most time goes to manual compiling at around 120 minutes, while analysis receives roughly 15 minutes. After automation, review and categorize takes about 20 minutes, and analysis and strategy increase to about 40 minutes. The point is that automation rebalances time toward higher value thinking. Next is a quick quiz. The question is, what is the primary reason manual spreadsheet budgeting fails as your finances grow? Option A, it is too expensive to maintain. Option B, it does not scale and leads to errors and delays. Option C, it cannot connect to the internet. Option D, it hides money from you. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. Now for the answer. The correct option is, it does not scale and leads to errors and delays. As accounts multiply, manual exports and categorization grow rapidly, causing broken formulas, missed transactions, and delayed reports. Automation addresses the scaling problem directly. Here is a second quiz. The question is, which path best fits someone who wants maximum control and is willing to invest setup time? Option A, subscription-based sync platforms. Option B, free accounting with envelope budgeting. Option C, doing nothing and hoping for the best. Option D, paper notebooks. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is free accounting with envelope budgeting. This approach provides deep historical control and custom reporting at the cost of more setup and discipline, which suits power users who want maximum control. In summary, the key points are as follows. Manual systems break under scale, making automation essential. Aggregate all accounts into one dashboard for clarity. Use rules for categorization to limit weekly work to minutes instead of hours. Choose between syncing platforms and free envelope accounting based on your preferences for convenience versus control. Test your categories with separate tabs before paying for anything. Finally, adopt a weekly review and monthly reflection cadence. To wrap up, you should replace hours of compiling with minutes of review, gain instant reporting and analytics, and choose the system that minimizes manual work for your style. That allows you to focus on strategy rather than data entry. Finally, thank you for watching. If this helped, please like the video, share it with a friend, and subscribe for more content. Tell us in the comments which path you will choose and what rules you plan to set up first. Your feedback helps us create better guides.